Are you over 50 and worried about your financial future? Maybe you've saved a little, maybe you've saved a lot, but you're wondering, where should I put my money so it stays safe and still grows? Don't worry, you're in the right place. In this video, I'll show you the safest investments after 50, so you can stop
Xin chào,
stressing and start feeling
chào mừng
confident
bạn
about your
đến với văn
future.
phòng của chúng tôi.
Hi, I'm Mark
Chúng
Davis,
tôi
and
rất
welcome
vui
back
khi
to
có
the
bạn ở
channel.
đây hôm nay.
Here we talk about simple, smart
Xin
ways to
chào,
manage your money and
chào
prepare for
mừng bạn đến
retirement.
với văn phòng của
If
chúng
that
tôi.
sounds useful to you, make
Chúng
sure to
tôi
hit
rất
the
vui khi
subscribe
có
button
bạn ở
and
đây
ring the
hôm
bell
nay.
so you don't miss future videos. All right, let's dive in. Here's the golden rule once you reach your 50s. Protect first, grow second. When you're younger, in your 20s or 30s, it makes sense to chase high returns and accept more risk. If an investment goes wrong, you have time to recover, rebuild, and try again. But once you're past 50, the game changes. You're no longer playing with practice money. You're playing with your retirement, the nest egg you've worked decades to build. Think of it this way. At 25, falling off a bike is no big deal. You get up, brush yourself off, and keep riding. At 55, the same fall can leave you sore for weeks. Financial risks work the same way. The recovery gets harder with age. That's why your priority should be safety. Your money should continue working for you, but it should do so in a way that doesn't put your entire future at risk. Growth is still important. You don't want inflation eating away at your savings, but it must come second after protecting your principal. So remember this simple rule. Never risk money you can't afford to lose. Every financial decision after 50 should aim for a balance, steady, reliable income, and peace of mind. First up, let's talk about high-yield savings accounts, often called HYSA. Think of them as the safer, smarter cousin of the regular savings account you might already have at your bank. The difference? They pay you a much higher interest rate, sometimes 10 to 20 times more than a traditional savings account. The best part is that these accounts are FDIC insured, which means the US government protects your money up to $250,000 per depositor, per bank. In plain English, even if the bank somehow went out of business, your money would still be safe. That's peace of mind you can literally take to the bank. Now, let's be clear. High-yield savings accounts won't make you rich. They're not designed for big, long-term growth. But that's not the point. These accounts shine when it comes to keeping your cash safe and accessible. They're perfect for your emergency fund, for money you may need in the next year or two, or simply for giving your savings a little extra boost without any risk. Safe, simple, and reliable. That's what makes high-yield savings accounts a great first step in protecting your money after 50. Next up, let's look at certificates of deposit, often called CDs. A CD is one of the simplest, most straightforward investments you can make. Here's how it works. You deposit a certain amount of money in the bank, and you agree to leave it there for a fixed period of time, say 6 months, 1 year, or even 5 years. In return, the bank rewards you with a guaranteed interest rate. That word guaranteed is important. Unlike the stock market, where values can rise and fall daily, with a CD, you know exactly what you'll earn before you even start. It's steady, predictable, and protected by the bank. And, like savings accounts, most CDs are FDIC insured up to $250,000. That means your money is safe even if the bank runs into trouble. Now, CDs aren't designed for quick access. If you take your money out early, you'll usually pay a small penalty. That's why they work best for money you know you won't need right away. Think of it like putting your cash on a short vacation. It takes a little break, earns some interest, and then comes back to you, safe and slightly bigger than before. Now, if you're looking for a way to enjoy some growth and steady income, let's talk about dividend-paying stocks. These are shares of well-established companies that don't just rely on their stock price going up. They also share a portion of their profits with you, the investor, in the form of regular dividend payments. Think of it like owning a fruit tree. The tree itself, the stock, might grow slowly over time, but while you wait, it's producing fruit season after season. That fruit is your dividend. You don't have to sell the tree to enjoy the harvest. You simply collect what it gives you. The companies that pay dividends are usually big, stable names you already know, utilities, consumer brands, healthcare firms. They've been around for decades and are less risky than chasing after the next hot tech startup that may or may not survive the year. Dividends can be paid quarterly, providing you with a predictable stream of income. And if you choose to reinvest those dividends instead of cashing them out, your investment can grow even faster over time. So dividend-paying stocks give you the best of both worlds. Potential growth plus regular income, a great mix for investors over 50. Another great option to consider is real estate investment trusts, better known as REITs. A REIT allows you to invest in real estate, things like office buildings, shopping malls, apartment complexes, or even hospitals, without actually having to buy or manage a property yourself. Here's how it works. A REIT is a company that owns and manages income-producing real estate. When you invest in it, you're essentially buying a share of that company. In return, REITs are required by law to pay out a large portion of their profits to shareholders in the form of dividends. That means steady, regular income for you. The best part? You don't have to deal with the headaches of being a landlord. No late night phone calls about broken toilets. No chasing tenants for rent checks. You get the benefits of real estate ownership, like income and potential growth, without the stress. REITs are also easy to buy and sell, since many trade on the stock market just like regular shares. That gives you flexibility and liquidity, something direct real estate investments don't always offer. So, if you want exposure to real estate without the landlord drama, REITs can be a safe, income-focused choice. Finally, let's look at balanced funds and target retirement funds. These are perfect if you want a hands-off approach to investing, especially after 50. Instead of you having to figure out how much to put in stocks versus bonds, these funds do the work for you. Here's how they function. Balanced funds hold a mix of stocks and bonds in one package. The stocks provide growth potential, while the bonds add safety and stability. It's like having a diet with both vegetables and protein. One gives you strength, the other keeps you healthy. Target retirement funds take it a step further. They automatically adjust the mix of stocks and bonds based on your age and retirement timeline. So if your target retirement year is 2035, the fund gradually shifts from more aggressive, higher in stocks, to more conservative, higher in bonds as that year approaches. In other words, the closer you get to retirement, the safer the fund becomes without you lifting a finger. The beauty of these funds is their simplicity. You just pick the one that matches your retirement year, invest, and let it handle the balancing act. Safe, convenient, and stress-free. Now, before we wrap up, let's talk about some of the biggest mistakes to avoid after 50. Mistake number 1, falling for get-rich-quick schemes. If someone promises to double your money overnight, run the other way. These too good to be true offers usually are. Scammers know many people nearing retirement are looking for quick fixes, and they take advantage of that. Protect yourself by sticking with investments that are regulated and proven. Mistake number 2, putting all your money in one place. Even if it feels safe, like keeping everything in a savings account, you're actually taking on another kind of risk, missing out on growth. Diversification is your friend. By spreading your money across different types of investments, you reduce the chance that one bad outcome ruins your entire plan. Mistake number 3, ignoring inflation. Playing it too safe can be dangerous. If your money isn't growing at least a little, rising prices will slowly eat away at your savings. Safe doesn't mean stagnant. It means finding investments that balance security with steady growth. Avoiding these 3 traps, scams, lack of diversification, and ignoring inflation, will help keep your retirement plan strong and your future secure. So, here's the bottom line. After 50, focus on protecting your money first, then look for safe ways to grow it, like savings accounts, CDS,
when it
bonds,
comes to investing
dividend stocks,
your money,
REITs,
there are
and
a
balanced
lot
funds.
of options out
The
there.
key is balance and peace of mind. If you subscribe, you won't just get more videos like this, you'll get peace of mind, knowing that every week you're getting simple, safe, and practical money tips for your future.